Stop trading every single support and resistance flip you see. You are just feeding the market makers liquidity. Most traders lose because they can't tell the difference between a weak retail bounce and a smart money shift. If you want to set up with an insane risk-to-reward ratio, you need to stop looking at basic lines and start trading demand to supply flips. In this video, I'm going to show you exactly how to spot the only flip that actually matters for institutional traders and how you can ride their wave for maximum profit. Let's dive in. Before we pick the best one, what exactly is a flip? In price action, a flip happens when a specific area on your chart completely reverses its role. It's the exact moment a price level or zone shifts from preventing price movement to actively pushing it in the opposite direction. Let's break down the first type, the support and resistance flip. This is the classic retail setup that almost every trader learns on day one. Here's how it works. Picture a strong resistance line where the price has bounced off multiple times. Sellers are heavily defending this level. After spending some time below the resistance, the price eventually builds enough buying pressure and breaks cleanly above it. Once that resistance is broken, it flips into a support. When the price retraces back down to this exact same line, old sellers are forced to cover their losses, and new buyers step in, turning that old resistance into a fresh support level. The exact same thing happens in reverse when a support level breaks and flips into resistance. While it looks simple and clean on a textbook diagram, here is the harsh reality you need to know. In real-time trading, these basic support/resistance lines are highly visible to everyone, making them the ultimate target for liquidity hunts and fakeouts by institutional algorithms. Now, let's talk about the heavy hitter, the demand to supply or supply to demand flip. Unlike basic lines, this setup is completely based on institutional order blocks and supply-demand zones. Imagine the market is in an uptrend, creating a strong demand zone. Price drops back into this zone, and retail traders start buying, expecting a huge bounce. But instead of rallying, something massive happens. A wave of institutional selling pressure completely overwhelms the buyers, destroying the demand zone and violently breaking market structure. The moment that demand zone fails, the exact area on your chart flips into a powerful supply zone. Why? Because the market makers who just forced the price down left behind millions of dollars in unfilled sell orders. When the price retraces back up into this newly flipped zone, those institutional orders get triggered, causing a massive, rapid drop. This isn't just a line on a chart shifting roles. This is a complete visual representation of major institutions flipping their bias from bullish to bearish in real time. So, out of these two concepts, which one delivers the highest probability setups? Without a doubt, it's the demand to supply and supply to demand flip. But what makes these flips so much more powerful than the traditional support and resistance flip? The answer comes down to order flow and liquidity. Traditional support-resistance flips are based on obvious retail levels that almost everyone can see. And because they're so obvious, they often become liquidity targets. Smart money knows where retail traders are placing their entries and stop losses, which makes these levels easy to manipulate. A demand-to-supply or supply-to-demand flip is different. Instead of focusing on retail reaction levels, it focuses on where institutional order flow has shifted. These flips often reveal areas where large participants have been trapped, forced to exit positions, or return to mitigate unfilled orders. Another major advantage is the risk-to-reward potential. Rather than trading from a single horizontal line, you're trading from a well-defined institutional zone. That allows you to place a tighter stop loss while targeting larger moves towards significant swing highs, swing lows, or major liquidity pools. The result is a much more favorable risk-to-reward profile. Now, here's the important part. Not every flip zone deserves your attention. If you start trading every demand-to-supply or supply-to-demand flip you find on the chart, you'll quickly discover that many of them fail. That's why validation is critical. There are 3 non-negotiable rules you should always look for before considering a flip zone valid. Rule number 1, strong displacement. The break through the original zone should not happen with weak candles or a slow grind. You want to see aggressive displacement, large-bodied candles, and clear momentum leaving the area. That kind of expansion tells you institutional participation is likely behind the move. Rule number 2, a clear market structure break. A valid flip should lead to a decisive break of a significant swing high or swing low. If the move fails to break structure, then the market hasn't truly shifted order flow. In most cases, it's simply a pullback rather than a genuine reversal. And rule number 3, fresh, unmitigated price. The highest probability flip zones are usually the ones that have never been revisited. The first retest is often where the strongest reaction occurs, because unfilled institutional orders may still be resting inside that zone. Once a level has been mitigated multiple times, its effectiveness tends to decrease significantly. Now let's break down the 3 biggest mistakes traders make with flip zones. Many traders think finding a flip zone is enough, but the real skill is knowing whether that zone is actually valid. Mistake number 1, confusing a break of structure with a real flip zone. The first mistake is assuming that every broken zone becomes a flip zone. A real flip usually happens after price reacts from the original zone and then breaks through it with strength. But if price completely destroys a zone without any clear reaction, that is simply a break of structure, not a valid flip zone. Understanding this difference helps you avoid trading weak levels with no real order flow behind them. Mistake number 2, ignoring the origin zone. Many traders enter from a flip zone without checking where the move actually started. In smart money concepts, the origin zone or decision zone is often where institutional orders were placed. Sometimes the flip zone is only a temporary area, and price can use it to attract liquidity before moving back to the true origin zone. That is why every flip zone should be analyzed together with the bigger market structure. Mistake number 3, ignoring higher timeframe context. A flip zone may look perfect on a lower timeframe, but the bigger picture can tell a different story. For example, a 5-minute flip zone might be sitting inside a daily supply zone or a higher timeframe order block. When that happens, the higher timeframe usually has more control. Trading flips the right way will completely change how you see the charts, but it takes practice. Now I want to hear from you. Have you been relying on traditional support and resistance flips, or have you already started using demand and supply flips in your trading? Drop the word flip in the comments below and let me know where you are in your trading journey. I read every comment, and I'd love to see how many traders are already incorporating smart money concepts into their analysis. And if you found value in this video, make sure to subscribe and turn on notifications. Every week, I break down real market behavior, liquidity concepts, institutional order flow, and high-probability smart money setups designed to help you see the market the way professional traders do. Thanks for watching, and I'll see you in the next one.